Hi, everybody. I think it was 11:01, so we'll get going. I know Craig is with us, but at the moment I can't see it up on my screen, but we'll sort that out before we get to talk to him. So I'll be talking to Craig Martin a bit, and I'm holding in a bit. But first, we're going to run through the news as normal, and then Andrew McHattie is going to talk us through what happened over the course of May. So news first. Just a couple of things that I thought I'd pull out. BMO UK High Income, where it's just finished a performance measurement period and has underperformed quite markedly, and Rights and Issues, where there's a change of manager after many, many years. So BMO UK High Income first. This is a trust that's been around for a very long time. It's one of the sort of oldest in the sector, and it for a long time was known as Investors Capital, and probably should have stuck with that name, I think, but there we go. It was a split capital trust for a while. So when the sort of mania for splits was around in the early 2000s, it opted to become one. And it was a combination of capital shares, income shares, zero shares, and some debt as well. And the mandate was to invest in UK equities and fixed interest with the aim of producing quite a high income. So that incarnation had a fixed life to the end of February 2007. So when we got to that sort of time, something else had to happen. So it was relaunched, and so it became effectively a new company, but it's essentially the same thing. And the thing was sort of slightly simplified, but not completely. So it's got quite a unique structure. It's got ordinary shares, which initially were called A shares, now just called ordinary shares, B shares, and units. So the ordinary shares get the dividends, the B shares get a capital repayment as though they've been paid a dividend, and then units are a combination of 3 ordinary shares plus 1 B share. That's slightly complicated, and I think that might be one of the things that puts people off, but yeah, we'll come back to that. Then it kept changing its name, so it became F&C UK High Income in January 2017. And then BMO UK High Income in November 2018, and it's now going to change its name to CT UK High Income Trust. And I think that doesn't help really in terms of marketing. It becomes a bit of a problem over time. It was run by Roger McNair for a long time, and he was a chap that I quite liked, and he did a reasonable job, I think. He handed over to Philip Webster in April 2017. And at the same time, the board decided that because the yields on the fixed interest part of the portfolio weren't that high anymore, and the shift of the balance of the portfolio changed, it would just drop the fixed income component of the portfolio completely. So it became a pure UK equity income fund at that point. It had quite a high yield. So here is the chart, and it is not spectacular. So that's over 10 years, and basically, as you can see, the share price and the NAV have really gone nowhere over that period. And it's traded at a discount pretty consistently over all that time. And there's very brief periods where it's traded at a premium, but it's never done. It's ever issued any stock. So, as you know, I think there are probably too many of these UK equity income funds, definitely too many small ones. Here are the returns. So you can see that really down the bottom here, it's ranking towards the bottom end of the peer group over just about every time period you can think of, really. So really not great. The board introduced 5-yearly performance triggered continuation votes, I think when the thing was restructured in 2007. So we had the last period, the one that ended in March 2017, it just managed to beat the benchmark, which is the all-share index, and so it didn't have to have a continuation vote. This time round, it's delivered a return over 5 years of 11%, and the benchmark's returned almost 26%. So it will have to have a continuation vote. Now, the reason why the performance has deviated so markedly from the all-share recently is because it doesn't hold any of the things that have been going up recently. So oil majors have been going up because the oil price has been going up. Mining shares have been doing well because commodity prices are rising. And its focus on quality and sustainable competitive advantage, those are the sorts of things that investors are actually shying away from at the moment. I don't quite understand why that's going on, but nevertheless, it is a value world and it's not a value type portfolio. So you can see here, this is the performance over 5 years, and it's underperforming here, but it's sort of tracking the index until we get to this chunk here where the growth started to underperform and value started to outperform, and then it sort of gaps open up quite markedly. Will it recapture that? Don't know. I don't think there's any intention to change the style. So we're going to rely on a shift back towards growth investing, I think, for that to catch up to happen. But whether that people are prepared to wait or not for that, we'll wait and see. So here we are, as it says in the sector. I think it's too small. So it's got a market cap of 112 million, which is just about big enough. So it's the combination of the ordinary shares and the B shares make the 112. But of these funds here, the 22 funds, it ranks 17th. So there are obvious smaller things that could disappear first, things like British and American. But nevertheless, I do think it is on the small side. Discount wise, as I've already said, that's wide-ish. I mean, that's not outrageous, 6.9, but it is towards the bottom end. The yield is very high. I think that might be part of the problem with the performance. And the ongoing charge is 0.98, again, towards the bottom end of the peer group. Obviously, the bigger funds, things like City of London, are much, much lower ongoing charging ratios. It's been marching the dividends up, which is a good thing, I suppose. It's not quite made its an AIC dividend hero yet, or I think it might be into the sort of next generation, or not far off that. That all looks well and good, but I think it started from a position of having too high yield in the first place, and so scrambling around to make that income, I think, is part of the thing that's compromised capital performance. And you can see here just how much it's distributing more than the peer group. So here's the distribution, here's the peer group, and here's the all share. I think maybe it's slightly over-egging it. So what we've got here is a summary of what the board's case for continuation is. So they say, first off, this was a funny old period because we changed the investment approach. Well, that was true, but it was done right at the beginning of this period. And didn't seem to much change the actual ability to beat the all share at the time. And one of the things that we have noticed is that things like Shire's Income, Henderson High Income, have actually been doing pretty well. So other equity and bond funds have actually done okay. So had it stuck with its approach, I think it probably might be better off. They say, well, you know, there are times when the trust has been outperforming. I don't think that helps me very much, to be honest, because it doesn't help anyone doesn't sell at the peak. There's an argument that Plumbing Thread Needle is better resourced than BMO. I think that's going to be very at the margin. There's no real question that BMO was too small to talk to the likes of Shell and BP. There is a slightly lower fee, which is always good news, but doesn't really make a massive difference. You know, it's going to add 0.05% to the returns over time. I don't think that's an argument to keep it. They say, look at the way the dividends have been rising and how much the revenue account's been bouncing back. They're actually massively over distributing. So earnings last year were 3.61p. Yes, up quite a lot from the COVID lows, but the dividends 5.45. So they're eating into their revenue reserves. I just think we might need this again because we seem to be heading towards a recession. So again, just another thing that says to me that I think the thing's over distributing. Because I suppose that they realise that people are a bit unsure of what's going on here. They're going to cut the performance measurement period to 3 years, which is good. But the things that I think people should be asking the board how they're going to be addressed, how are you going to narrow the discount? How are you going to grow the fund? And how are you going to raise awareness of it, especially when you keep changing your name every 5 minutes? So I I think it'll get through its continuation, but I think it's got a lot of work to do to get through the next one. If it underperforms in 3 years' time, I think it might be toast. That's that one. Rights and Issues is a very different story. So this is a fund that's been around since 1962. It's a UK small cap trust, always has been. And it was one of the original split capital trusts. So there were a clutch split capital trusts that predated all the ones that were created in the 2000s. And this was one of those, but they were much simpler vehicles. So basically just had capital and income shares. And again, it's a structure I don't have a problem with at all, because there's no sort of gearing inherent in it, and it doesn't sort of create problems. Simon Knott became the manager of the trust in 1984. I think he was only 24 at the time. But the reason he got the job was that his dad was a director and a substantial shareholder in the fund back in the 1970s. So there was obviously a family connection there. And so obviously he's now one of the longest standing fund managers in the sector. I think he's only just behind Peter Speller in terms of his track record. It was a split cap, as I say, for a long time. In June 2016, it became a conventional trust. They just merged the capital and income shares together. One of the sort of unique characteristics of this is that it kind of relied on its performance record to market it, and really did not do much in the way of promotion. It still doesn't produce fact sheets. It's quite hard to find the website. Really, it's almost avoiding the limelight sort of too much, I think. Here is the performance chart, and we've all been hit by this dent with COVID, but actually it's done okay over 5 years. Unfortunately, this only goes back to the reconstruction of the fund in 2016. So Morningstar counts as a brand new fund at that point. One of the things, though, it used to trade at a premium, and it hasn't done for most of this 5-year period. I suppose UK small caps haven't been that much in favour. It hasn't been leading the performance tables all the way through this. For a long time, it really was a standout performer. But it's done, yeah, it's still done pretty okay. Obviously, this lack of self-promotion is not helping either. So it's one of the things that Jupiter may be able to address. So here we are. Here's the track record, and it is pretty spectacular. So it's the purple bars are the fund, and the light blue bars are the all-share index. And basically, you can't really see the all-share index going up because the purple bars are so much higher than it. Yeah, it really is a fantastic record that he's produced. And here it is within the small cap sector. And again, there are probably too many of these funds, and probably too many small ones. So there's some very obvious ones that could disappear. Like there's that Chelverton, SVM UK Emerging and Worsley, those sort of tiny things. And its market cap is sort of middle of the pack, discount not too bad. It's not really run to produce a yield, but there is a small one. Where it ranks really very well is on its ongoing charges record, because it's a self-managed fund. So only really it's got to cover is sort of the admin costs and any money that someone's to take out of it. So that ongoing charges ratio has been very low, 0.35. There's the track record. As I say, it's not been top of pops recently, but it's still over 10 years. It does rank second, so that's still not bad at all. And to answer Kevin's question, so Simon is just about to retire. So he's decided to step down with effect from 1st September 2022. And the board has decided to give the management contract to Jupiter. The manager at Jupiter is going to be Dan Nichols, whose track record is with the Jupiter UK Smaller Companies Fund, open-ended fund. They're saying there's absolutely no change to the investment objective policy and not much change to the portfolio. I do think they probably will make it slightly less focused. So again, there's no fact sheets with rights and issues, but when we look at the last set of accounts, I think Treat, the flavour and fragrances business, I think was well over 20% of the portfolio. So I think Jupiter probably will be a bit uncomfortable with that, so we might see that come rattling back. What we will get, because it's now being outsourced to a new manager, is a much higher ongoing charges ratio. This they've agreed to cap at 0.8%, so that's the overall expense of the fund, not Jupiter's fee. So Jupiter will earn whatever money basically is the difference between the admin charges and 0.8. And because they recognise that some people might not want to go with the new manager, they're offering a 10% tender at a 4% discount. That's not too bad. I think from some of the comments that I've seen that it might be oversubscribed, but then it'll just going to be down to Jupiter to kind of prove that they deserve to be there, and things are going to carry on. This is the track record of the open-ended fund. And you can see here basically that it had a very good period from about 2015 to 2018, and since then not quite so good. I'm hoping that for Jupiter's sake that the thing turns around. Otherwise there could be eruptions, and we shall see what happens. That's enough on those two. There's a couple of questions I should just answer quickly. So why do I think there are too many UK equity income funds? Basically because I think you don't really need an awful lot of choice here. So 15 funds would be plenty. There are an awful lot of open-ended funds doing the same thing. I do think, though, that as a few boards decided over the years, there's too much of a concentration of income within the UK equity market, so which is why the BMO fund's been carried out. So if you don't own things like Shell and BP and some of the banks, then you are those are the things that reduce the income in the UK. Looking overseas, to me, makes much more sense, and so there are a number of global equity income funds that have done that. We could obviously, we were hoping that the UK were going to have a much better period for a while, and that hasn't really materialised. I heard that BMO weren't interested in the fund, it's a bit on the small side. I hadn't heard that. I don't know. I mean, but that is the part of the problem. If it's only £111 million, and there's no prospect of growing it because of a discount, does the manager lose interest? Does it become a kind of also run thing? I hope not. If that is the case, then they really should be thinking about trying to merge it with something else, which is a bit more popular. And yeah, as for whether the tender should be at a 4% discount or something narrower for rights and issues, there's a sort of balance here between favouring the ongoing shareholders and shareholders that want to exit. And that's a tricky thing to balance. And obviously, if you want to get out, then 4% is going to seem too wide, and if you want to stay in, it's going to seem quite reasonable. Anyway, enough of me. I'm going to hand over to Andrew.
Great, thank you very much, James.
Who's not great, Martin, but let's.
I'll just share my screen. Yeah, that was very interesting, actually. Thank you. And I remember talking to Roger McNair quite a bit, actually, in the earlier days of the CT UK High Income Trust. And I think back before ISAs and SIPs were quite as prevalent with private investors, it was quite a good idea to have the A shares and B shares that treated the income in different ways for you. But maybe that idea has had its day now. So let's have a look at what's been happening over the last month or so. Here's the list of biggest gains. You can see JZ Capital Partners at the top, which makes a change. That's because of one particular successful sale in the winding up process there. And there's a reasonable smattering of gains. JLEN Environmental Assets is on the list. That was recommended by Investec and Stifel as well. And I noticed a note the other day from Hargreaves Lansdowne recommending 3 investment trust ideas to help protect the planet. That was one of them, along with Impacts Environmental and the Renewables Infrastructure Group. So that's quite well liked. But I think actually the main theme, undoubtedly, is China here, where we have all 4 of the specialist trusts on the list of risers with some very good gains. So I'll talk about those. And moving on to the fallers, Again, the usual mix, JP Morgan Russian at the top for obvious reasons. And I think the other theme, which has been very much an ongoing theme, is that growth investments, as James was saying, are still very much out of favor. So those are continuing to fall. But I have talked about those quite a lot over recent months. So I'll just talk about something different today, which is the UK micro-cap trusts and also Golden Prospect precious metal, which is quite an interesting one in relation to the gold price. So China then, the reason for the fairly substantial bounce this month was undoubtedly the news that Shanghai was reopening after the COVID lockdowns. And so I think that is obviously very welcome news and a very reasonable reason to provide some positive catalyst here. However, I think when you look into it in a bit more detail, you can see that it's not a complete reopening. It's not as though the Chinese government has said, right, we're all good to go now, and we're finished with the lockdowns, let's get back to normal life. That's really not the case. There are still restrictions in place. And I noticed the most read article on the FT website at the moment is about how China has been building its infrastructure so that it can maintain its zero COVID policy with a lot of testing. So I think there is a significant risk of further lockdowns to come. So I wouldn't say that the decks have been cleared here at all. And really the intervention of the government is central to the investment case here, not just because of the COVID lockdown policy, but also because of what else it does. So it clearly is trying to restart its economy now. So it's coupled the end to these lockdown measures with some stimulus as well. And at the same time, it's ended a bit of a regulatory crackdown in certain sectors, which included ride sharing, a company called Didi, and a couple of others that are listed on the slide here. So overall, the package, I think, was very well received by markets, hence this significant relief rally. This is a one-year chart. You can see the market, has drifted off for most of this calendar year to date, and then reached its trough here in late April and has bounced since. It's still down about 9% over the year, but has had a good bounce over the last month. I would just caution against getting overexcited though, because I think this zero COVID policy isn't going away, so we're not quite finished with it yet. But if you are looking at the Chinese investment trust, you've got 4 specific single country trusts from which to choose. I think Aberdeen China is still a little bit of an outlier here. It only converted last autumn, and maybe that's not really complete yet. That was from the merger of the Emerging Companies Trust and Aberdeen New Thai. So it's slightly out of alignment with the other 3 actually, but you can see from these one-year performance figures here that they're all pretty dreadful. But in particular, the other 3 here, they're very similar. They're all down by about 30%. And I do struggle to differentiate these a little bit. I mean, clearly one isn't normally using one-year performance figures to make any significant judgments, and you look out to much longer periods. But it's difficult to do that here because this is a relatively new subsector, and these trusts have changed. So JP Morgan China Growth and Income has been a stronger performer over 3 years, but it's not easy to compare, partly because it has changed its mandate, and I think the name here is a bit misleading. It's called a Growth and Income Trust. The income only comes about because it's fabricating an artificial dividend. yield by paying it out of capital. So it's not really an income trust in any shape or form as far as its portfolio is concerned. And my opinion is that this slicing off a bit of your capital and giving it back to you every year is bound to undermine the long-term returns, because you're either introducing costs of reinvestment there, or you're obviously reducing the capital that you have invested. So I'm not sure how that's going to play out here if you're a long-term investor in China. And the Baillie Gifford China Growth Trust is also a comparatively new one. That was Witan Pacific. That only converted in 2020. So we don't have the luxury of a good long track record to really examine how these trusts have performed through the cycles. There's not much difference in the market ratings either. And when you look at their individual portfolios, again, there's quite a lot of overlap in some of the investments. So Tencent is the largest holding for all three of these more established trusts here. So I think it's quite difficult to differentiate between them. Having a look at their three share prices over the last year doesn't help. They've all moved pretty much in tandem. The green line here is the JP Morgan one, which in share price terms has been slightly behind because it's derated a bit. But again, not very much to choose between them. On that basis, I think for many investors, unless you have a particular style preference, and that may ultimately be the main determinant for you, if you prefer the Baillie Gifford style or the JP Morgan or the Fidelity style, if that's not something that's important, then I suppose the liquidity is the main feature that's going to attract you towards Fidelity China, because it is much bigger. So it's 1.4 billion market cap against 200 or 300 million for the others. So for that reason, Fidelity has a slight edge if you're indifferent. I think it's quite difficult to choose between them. And actually, at the moment, I'm not particularly sure I'd choose any of them, because I think the risks are still quite high here. And this knee-jerk market rally may or may not be sustained. I don't really know. I think there's a more general point here as well, which is that if you're sitting in your office or your home in the UK trying to analyze these trusts, it's actually quite difficult to do so on a day-to-day basis, to really follow what's going on, which is why actually it's so valuable to hear from managers of single country funds in Asia. So very glad to be hearing from Craig in a while. So I'll move on now to the fallers and to UK micro caps. I did speak to George Ensor, the manager of River Mercantile UK Microcap, a few weeks ago, and just asked him really about why microcaps were selling off, and he said, well, this is just what happens during risk-off periods, really, that the sector is just treated as something you don't want to be in when times are hard. And I think that's probably true, that these act a little bit like a warrant on the UK market. They give you a bit of geared upside exposure during good times, and then everybody sells out when times get tough. In part, I think that's because the micro cap sector is naturally a bit more domestically oriented with its sales, although the UK is such an international market, I'm not sure that's a strong factor. But it does mean, actually, if you're thinking about the UK consumer and the current difficulties that we all have paying our bills, then potentially micro caps will be harder hit. It doesn't help when the OECD says that the UK is not going to grow next year, and that we are the worst of the major economies after Russia. I mean, that's not nice to hear, and it's not helpful. But actually, of course, anybody who's studied the stock market any length of time knows that there's only a the most tenuous of links between GDP performance and stock market performance. So I wouldn't worry about that specifically too much. The chart here is an MSCI chart of 3 indices. The cyan colored one, the light blue one here, is the world index. The yellow one is the FTSE All Share, effectively the broad UK index. And it's the middle one here, the dark blue one, that is micro caps. And you can see actually they've had periods of under and over performance. They underperformed during the COVID dip, as you would expect, then had a really quite significant period of outperformance, which is now being corrected, so they're being pulled back. And that, I think, just shows exactly the point about the micro caps being a warrant on the UK market. I do think that the managers are sort of bravely stating their case as they must, but it's been a torrid year. This is a 1-year chart. The black line here is River Mercantile UK micro cap. The blue line is the Miton UK micro cap. They've both done very badly in share price terms. And so I think it's quite an interesting question to just consider whether those might be worth buying at these lower levels. The River Mercantile Trust is a particularly interesting one with a unique structure. It's really, to my mind, it's the reverse of an open-ended fund, where it actually gives you money back at the right time in the market cycle when it's done well. It basically, when it grows too large, and therefore the manager may be running into liquidity constraints, it gives some capital back, which it has done actually quite successfully in the last couple of years. But it's nowhere near that point now, of course, having fallen so sharply. It has fallen to a substantial discount now, which is 18%. And whilst it is the bottom of the NAV rankings over 1 year, actually it's much better if you look out a little while and to a longer date. I quite like the trust actually, and the manager says he believes the drawdown now is at pretty extreme levels and that we're closer to the bottom than the top. I hope he's right. I think you would have to accept that if you're thinking of buying it, you're taking on quite a lot of risk here. And I think that may be something you're comfortable with, particularly if you're dribbling some money in through a monthly scheme or something like that. But clearly, you're taking a considerable risk on. The Miton Trust, which hasn't done as badly, hasn't fallen to such a wide discount, actually. It's only about 9% there. Its NAV ranking is mildly better, not much. One curiosity here is that the trust does own a FTSE 100 put option, which covers about 40% of the portfolio. I mean, that's an interesting thing that Gervais Williams has also adopted in the past for diverse income trust. And I can see it's useful because it gives you capital at the right time when you really want it to reinvest if the market has really dived. But it's not being very helpful at the moment because, of course, as James pointed out, some of the old industries, mining and oil in the FTSE 100 are doing very well. So actually the FTSE 100 has held up really well whilst the micro cap sector has been falling. So at the moment, that's not really working, but it could potentially do so in the future. I'm conscious of the time. There's just a couple of quick questions. I have been asked if I selected a Chinese trust as one of my annual ISA selections. That's a very good question. I did. It was the Fidelity one, basically on the basis of the liquidity and the cheapness of Chinese stocks and the fact that they were depressed at the time. I can't claim any credit whatsoever for the bounce, and I think actually they may still be down on balance. And the other question is just on UK small caps in general. They sold off pretty hard. We all know that small caps outperform over the long term, and you're certainly not buying them at their peak now. but I think it depends on your risk tolerance. So you're certainly buying into a more punchy, volatile sector if you're buying in now, but might not be the worst idea in the world. That's it. I'll hand you back now to James to have a chat with Craig. Thank you very much.
Thank you, Mitch. Thank you.